Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks. So today I'm going to talk to you about the option to refinance. Because interest rates are so low, this could be a great time for you. If this is your first time joining me here on the channel, go ahead and hit that subscribe button and you will be notified every time I upload a new video. So one of the good advantages of having these low interest rates or the Fed moving that interest rate range from 0% to 0.25% is it opens the opportunity for you to possibly refinance your debt. But how do you really determine if it's a good time for you to refinance? So I'm going to talk to you a little bit about how you can look through and look at your car loan and also your home loan to see if this potentially is a good time for you to refinance. So first, your car. So many times when you think about refinancing, you have to understand what refinancing actually means. So when you refinance a loan, it means simply that you are saying, hey, instead of paying Bank A $2,000, I want to pay Bank B $1,000. So really it's you want to pay less interest for the loan. Obviously you want to pay the loan off, but when you're refinancing, it's all about how much interest you're paying. Because the lower the amount of interest you're paying means the more money that when you make a payment goes to your principal balance. So let's get that understood first. Next, when you look at your car, then you have to understand, hey, there are a few factors you want to consider. How much time is left on your car loan? Where are you at in the payments right now? What's your current interest rate on the car? There are a lot of things to consider with a car, but it can be a fairly simple process. The reason why car loans are pretty much easy to refinance, just like if you were to get a personal loan or things of that nature to pay off your credit card debt, is because typically there's no prepayment fee or any type of fee involved to refinance a car loan. The process honestly can take just about 30 to 45 minutes, depending on how confident the person you're working with is. But needless to say, it can be a great opportunity for you to look at, hey, did I have a 5-year car loan? What interest rates do I actually qualify for? And how much would I have to go? The thing about it is, with a car loan, you know the longer you keep the loan, the longer you keep the car, that car is going down in value. So it's important for you to know what that current lender you have, what their requirements is for the car loan. Sometimes they'll let you go over what's 100% of value just so that you can do the car loan. But it's understanding right now, most people do carry some sort of debt on their actual car loan from either warranties or just depreciation, or what's even worse, a previous car loan that you rolled over when you actually bought this loan. So it's very important that you understand where you are as far as what your current loan balance is, how much the car is worth, what is your current interest rate, and then you take that information and you simply call up lender, preferably probably a credit lender, credit union lender, because they usually offer more favorable terms and it's a little bit easier for you to get the loan done. But you want them to tell you, hey, what would be my current interest rate for for the time I have left, and proceed as you're writing those numbers down to really compare. Now, one factor you want to consider is with a car loan or with any loan, the loan interest is front loaded, meaning the bank wants to get their money first. So if the bank already got their money in those first 2-3 years, you're not really paying much interest in a car loan because, again, the time is smaller and the numbers are smaller. But what makes actual sense for you to actually refinance the car loan? Another good opportunity. So if you have a car loan that is a 9%, and then you're able to move to like a 6%, a 5%, a 4%, something of that nature, that is going to make excellent sense for you to do. And you're especially going to want to decrease that term so that you're not re-extending that loan out to your original 60-month or 72-month, whatever you start off with in the loan. But the important thing is to understand is you want to look at how large the number is that you're currently at. Because in a car loan, because the numbers are already so small, meaning how much you owe and potentially where your current interest rate is and where you can actually move to, it won't necessarily make mathematical sense. You can actually refinance your car loan and pay less interest, which would be a good thing, but your monthly payment can increase. And typically, when you're refinancing, one of the benefits of actually refinancing a car loan is to get the cash flow benefit of the monthly payment decreasing. So that's just something you want to consider as you're looking at your particular car loan refinance. Now let's move to something that's a little bit more complicated, the house loan. So if you're thinking about refinancing your home, there are a little bit more factors you need to consider but you want to take the same information that you did with your car loan. So you also want to consider how much time do you have left in the loan? What's your current interest rate? And what interest rate would you qualify for? But how the home loan is actually factored has more things to consider because, number one, a house goes up in value. So typically you're not looking and weighing your cost against the potential depreciation because in a car loan, they may upcharge you for taking on that extra debt. But in a home loan, you're more looking at, okay, my house has appreciated. I also can make a huge impact by just moving something as simply as 1%. A 1% decrease in interest rate can make sense as long as you keep the home for about 2 to 3 years. That's when you typically break even from that. But then it's not the interest rate that you're breaking even for, it's the fees that you have to pay to get the interest rate. Because in a home loan scenario, you actually have to pay to refinance that home loan. So you really want to vet out this decision and really think about it because it could take about a 30-day process, but you want to make sure you're making the best overall decision for yourself. So things to look for are how much can you actually save on the interest rate? How long do you actually plan on being in the home? Are you paying anything like PMI insurance? PMI insurance is private mortgage insurance. This insurance is actually an extra fee that doesn't go to your principal, but only goes to the bank, and it's actually insurance that insures the bank in case the home loses value, things of that nature. So this is protecting the bank, not yourself. But you get PMI insurance because if you didn't put 20% down it when you first bought the home, that's how it's typically waived. The house has to be at 80% loan to value. Well, why does this come up now? Because when you're thinking about refinancing, typically your home has already gone up in value. So you can drop that PMI just by simply refinancing the loan. And in most cases, because of how most loans are underwritten, that's the only way you can drop the PMI insurance. Otherwise, legally, they can't drop it until you have paid 80% of the loan, not when your loan to value is 80%. That's a little bit tricky. But the other piece about your loan to value and how much the house costs, that factors into what rate you can actually get. So when you think about refinancing your home, you want to know what's your home current value, what's your current credit score. Typically to get the highest rate or the lowest rate that's offered, you're really looking at about a 740, 750 range and above. And then you want to look at what term are you getting. So at a 30-year fixed rate, you will actually get the higher rate. For a 15-year, you actually get a lower rate, slightly lower. But right now, all rates are lower. So if you're able to drop about 1% or more, that will make great sense in either case for you to actually refinance. It can be a great opportunity for you to look at. Then you just have to simply look at how much are you paying for the process. And once you figure out how much you're actually paying in the process and how much interest you will save per year, then you can figure out how long will it take for you to get your money back for paying for this refinance. And in the case of, like I said, if it takes about 3 years for that balance out, you have to ask yourself, will you be in the house for 3 years? That makes the decision really easy, because if you're planning on being there for 3 years or more, then you'll recoup the cost and it will make sense to actually do it. The other thing that refinancing at this point with a home can offer you the opportunity to do what's called of refinance cash out or cash out refinance. And the thing about a cash out refinance is it allows you to pull some of the equity as you refinance this loan and use that equity to pay off other types of consumer debt or debt that you may have that may be pulling up your budget. Is this a good idea to do? Well, in theory, it could be, because if you're not really going to be in the home for the next 3 to 4 years, after 3 to 4 years, like this isn't your forever home, you know you're going to move for whatever case may be, then this is an opportunity where you can take some of the benefit of your asset and clear up some of your monthly cash flow and give yourself some breathing room in the process, because essentially that debt will be paid off in full because it's a part of the mortgage now when you actually sell the home. I hope this all makes sense. I know it can be a lot of jargon, and I know it can be very cumbersome to think about, should I refinance, should I not refinance? Well, it's really not that difficult when you look at, again, long term. Every decision that you're making right now, it does have short-term benefits, but you ultimately have to think about, in the case of a car, how quickly were you going to pay this car off? In the case of the home, you may not be paying your home off in the next 2 to 3 years. And if you are, it probably won't make sense to refinance. But you may be actually moving, or you may be transitioning, things of that nature. So if you know those things and you factor that in, that will help you make a little bit better decision. After that, then it's just about simply shopping around, making sure you get the best benefit, because right now, if you're qualified, banks want to lend you money. So if banks want to lend you money, it may take you a little bit more time as far as more conversations, but you can negotiate a lot of those fees. And again, the less you pay can make the deal a lot better for you in the long term. I hope this information is helpful. And again, right now can be a great time for you to refinance. And if you like this video, go ahead and give it a thumbs up for that YouTube algorithm. I can't wait to see you in the next video.